Hello and welcome to Buy, Hold, Sell. Today we're talking about dividend stocks, those that can give you better yield than the market, maybe a little bit of a surprise in the future as well. To help me talk about these dividend darlings, I've got Peter Gardner from Plato Investment Management and Hugh from Atlas Funds Management. Gents, thanks very much for coming in.
Thanks for having us.
Now we're going to go over a couple of stocks in a quick Buy, Hold, Sell episode to let you know how we came up with this eclectic list of names. We scanned the market for stocks with yields better than 4%, so ahead of the market, which is 3.5%, maybe a little lower at the moment. But we also wanted to see that they were going to be maintaining or even growing those dividends over the next 2 years. As I mentioned, it's an eclectic mix. Let's see what our experts think. Pete, I'm going to start with you. Fund manager, GQG Partners, buy, hold or sell?
Look, it's a hold for us. It's on a PE of 9, so it's incredibly cheap. It has been growing recently and fund inflows have been strong. The challenge for us is that more recent performance has been challenged. So they've been underperforming the market. They had a bet that the market would go down in this recent period, and obviously we know the market's been continuing to rally. And so we think kind of flows follows performance. And so with that poor performance, eventually you'll see that flow through into their flows data. And so that's what kind of keeps us back from owning this one.
Okay, it has had a great couple of years, hoovering up a lot of fun. Buy, hold or sell on GQG?
I think they can maintain their dividend,
Yep.
but I'm really wary of owning fund managers. Magellan used to pay a dividend of $2.15 a share. Last thing it paid 50 cents. Fund managers can fall out of favour, similar to what Peter says, and money can come in and out. So as a consistent dividend payer, fund managers probably aren't. I think Magellan paid 50 cents last year. I don't think they're going to pay that this year.
Okay. All right, let's go to Liberty Financial Group,
Yep.
commercial loans, buy, hold or sell?
Very variable dividend yield. My question is what the one shareholder owns 75%. I generally wouldn't like to own a company where there's one shareholder owns such a big part of the register, because often they can have very different dividend or investment horizons and thesis to individual investors. I think that dividend's going to be under a bit of pressure. They're in a much more competitive environment for loans. They've cut the dividend before in the past, only 2 years ago. Yeah, I think it's a sell.
Okay. Pete, buy, hold or sell on Liberty?
Yeah, it's a sell for us as well. I agree with what Hugh said. The other thing that's worth noting is that with the extra competition in the banking margin, when you look at their net interest margins, they've been dropping significantly over the last few years. And so, yeah, we think going forward, we want to see that stabilise and some positive momentum in that before we look at Liberty.
Okay. Next one, Homeco, code's HDN, buy, hold or sell?
For us, it's a hold. It's a very stable business. It's got long-term kind of tenants with pretty kind of stable companies like Coles and Woolies, but it's not kind of cheap enough given how much growth it's on. So for us, it's kind of fairly valued. It's got a dividend yield around 7%, but not enough to get us in.
Gee, 7%? Can't get you in for 7%. I'd love to know
Well,
what you do like.
Yeah, with no growth on that.
Yeah. Hugh, same question for you.
I reckon it's a sell. Similarly, it lives above its means. So when you look at LPTs, we look at a metric called adjusted funds from operations, which looks at your free flow cash minus your maintenance capex and your incentives. Home pays out far greater than their AFFO, about 110%. That's a sign that they're going to have to cut it at some stage, because them as landlords, they have to maintain the quality of their assets in order to keep tenants, and they have to pay incentives to keep tenants. We saw prior to the GFC, a lot of Australian Aussie LPTs lived above their means, paying these great yields. They did really well, but eventually that has to be cut. They're not reserving enough cash to maintain the quality of their assets.
All righty. Next stock is Dalrymple Bay Infrastructure. Before you give me your buy, hold or sell, can you give our viewers a bit of an explainer on what it does?
Okay, so it's a quite an interesting company in that they own a port up in Queensland that loads coal on it, but they don't actually have to operate it. They're just the owner of the assets. It's sort of a lightly regulated utility. They have take or pay contracts, generally quite long term, moving generally met coal out of the Bowen Basin off to the world. And they don't have to operate it, so they don't have the stevedores, they don't have any union problems. That's all dealt by the owners of the asset.
Yeah.
It's quite an attractive sort of long dated asset. Yeah.
Okay, and is it a buy, hold or a sell at
We're
current
buy.
prices?
Yeah, we're buy at the current prices. Recently, Brookfield sold down. So, unlike the first two in the list, GQG and Liberty, there's no chance of them coming to the ASX 200. There's a reasonable chance of Dalrymple Bay coming to the 200. Brookfield sold down 23%, so the free float's looking a little bit better. They'll face a bit of a higher interest cost the next couple of years, but that's going to be offset by higher charges on the infrastructure. So I think, yeah, it's a very interesting looking company.
Okay, Peter, buy, hold or sell on Dalrymple Bay?
It's still a buy for us. We actually picked this one a couple of years ago, and we're pretty happy because it's gone from $2 to $4.50 during that time. We think during 2 years ago, the market was definitely expecting those coal assets to go down over time. Obviously, that was kind of when we were peak kind of period for climate change. Now, at the moment, given kind of we still haven't found another way of creating steel other than met coal, we think that infrastructure asset will continue going for kind of potentially longer than the market expected. So it's now rallied to kind of take that into account, but it's still sitting on a pretty good yield. As Hugh said, with take or pay contracts that are scheduled to increase, so its dividend should be able to kind of grow from here over the medium term. So we still like it.
Okay, next stock, NRW Holdings, buy, hold or a sell?
It's a buy for us as well. It's a mining service company, which is obviously variable. It's one of those more cyclical companies that you've got to be wary of. But a lot of its customers are large customers that are doing more investment. It's got a pretty good order book at the moment, so we think its earnings are pretty solid for the next few years. Obviously, these companies, there's always a risk that something could blow up and they could mismanage the contract, but we think it's priced for that. It's on a pretty low PE of around 12, I think it is, with a yield of around 7%. And so, yeah, we like it.
Okay. Hugh?
I'm the reverse. Sell. Mining services and contracting companies are not the place to look for consistent dividend yields. Unfortunately, I've owned other companies like that in the past, like Leighton's, and generally you've been surprised very heavily on the downside where something just comes out of left field. Yep. Whilst they have to get new contracts every couple of years, it's just a little bit too sort of volatile for my taste. So I think it's And also they've got that $113 million liability to One Steel, which they're attempting to recover, which could sort of create a bit more sort of conservative on the dividend payout going forward.
Okay, Hugh. Last stock on my list, Origin Energy, big, pretty stable, buy, hold or a sell?
It's a sexy tech company.
Well, is that because you get your bill in the email, is it?
No, their investment in Octopus Energy.
Oh, right, of
so
course.
They made a small investment about sort of four years ago in this US and so UK-based Octopus Energy. Yep. I think for £230 million. Now they've made a little bit more. They own about 23%, all in a bit over £500 million. Part of that it's about to be looking to be IPO'd with Origin stake worth about sort of £2.3 billion.
Wow.
It doesn't earn any money though. Looking through it though, but because Octopus doesn't make any money, it doesn't really impact Origin's dividend. Two things there, I think they'll be able to maintain their dividend. APLNG, some of the new pricing with the Chinese is coming off, but they're getting higher energy prices, particularly in New South Wales, and that'll maintain the dividend. So yeah, it's a buy.
Yep, okay. Origin Energy, Pete, buy, hold or a sell?
It's a buy for us as well. So they have struggled a little bit over the last year as oil and gas prices have gone down, but the
share price is just straight up.
Yeah, I know, but their earnings over from AP and LNG has been dropping, but it's been benefiting from that Octopus investment, as you kind of mentioned. The other thing worth noting with them is that Aussie Super obviously avoided the takeover a couple of years ago, which I think was good for the Aussie market because Origin I think is going to end up being worth a lot more than that takeover price.
Okay, so a few ideas from the scan we ran, but we're not flush. Let's finish it off with a couple of your top dividend picks. What have you got for us, Pete?
Yep, so our dividend pick is potentially one that people wouldn't expect. It's another cyclical company, so Hugh's unlikely to like it. But Qantas is our pick for this one. Now, Qantas is doing incredibly well in the current market environment. Obviously, travel since COVID has been booming. It's still booming. They're in a cosy duopoly in the Aussie market where most of their earnings come from the domestic business and their frequent flyer business. Even though there's lots of Qantas haters out there and I've had my own share of arguments with the Qantas staff, we still keep booking with them. And so we think Qantas are still relatively cheap, of a PE around kind of 10, with the ability to grow as well. Yeah,
I grimace every time I check out. The flights are almost double what I used to pay a few years ago, but I don't have a choice where I come from. So someone's getting the money. Hugh, what's your top dividend pick?
Probably more boring than Pete's here. Amcor, the world's largest packaging company.
That is boring.
Very boring, but there's no alternatives. You can't get your medicine in a brown paper bag. Yep. They're benefiting from a range of acquisitions. They've recently attacked the acquisition of Berry, further increases their size. That's going to be quite substantial earnings per share accretion, around about 10% a year for the next couple of years. Trades on a 5% yield, paid in US dollars, paid quarterly, benefiting from the size. Been payout ratio of 60%. That's something we look at quite closely. Yep. We like it. There's no alternative to packaging, particularly in medicine and food and a lot of flexibles. Yeah, I think it's a very good quality, consistent dividend paying pick.
Yeah, well, for those of you out there looking for income, sometimes boring is beautiful. I hope you enjoyed that episode of Buy, Hold, Sell, which is part of our income series taking place on Livewire right now. Go check it out.